the year ahead depends on a couple of things. One is the earnings picture, which is hard to forecast. The other, you say, depends on the Fed playing nice. What do you mean by that?
So obviously, one of the big overhanging pieces of the volatility and the two corrections we've seen this year is the Fed moving interest rates up too fast? And if so, is that going to cool the economy? Is that going to make bonds by comparison more competitive to stocks? That's certainly a reason for PE multiples to compress and for stocks to have, more of a challenging path up higher. So we're looking into 2019, if the Fed were to come out and cool the pace of interest rate hikes, which we are seeing in recent language from the Fed, and even Jay Powell in the last meeting they had, they're talking about maybe 2 next year. We think that's probably high. Maybe it's 0 or 1. If they were to play nice and listen to the market a little bit more closely and change their monetary policy, at least the path and the expectation to continue to hike interest rates, that could be good for stocks going into next year. So that's what we mean by that.
John Merrill, I'd like to get your reaction to what Jason just said, but point out that you like as an investment next year, and this suggests that you think the market's going to do pretty well. You like an index fund that invests in the total U.S. market, Vanguard, whoever.
Right. Well, no, we have a little bit different view because we're long-term investors. So even 1 year is a pretty short time frame. But as I look at 2018, it provided 2 wonderful opportunities for long-term investors. Back at the beginning of the year, we had a blow-off top from an extended bull, which created a wonderful opportunity for getting more defensive. And then in the last week, the total U.S. market was down 20%. While earnings were up over 20% for the year, which created a meltdown in PE ratios and a melt up in market attractiveness. Even if this isn't the bottom, it is a very attractive entry point for adding aggressiveness to the market, to your portfolio. So as we look ahead from this point where we are today, for the first time in several years, I'm happy to say I can say that the next 3 to 5 year expected real return from the market is above average, and I haven't been able to say that in quite a while.
Well, John, real quickly, why do you look at the total U.S. stock market instead of the S&P 500?
Well, because it has the full mid-cap, small-cap component. You're just capturing the entire market. Right now, I think that's more important than perhaps earlier in this bull market, simply because the small caps and mid caps have trailed. They have better earnings momentum right now versus their prices. So I think the total market, and again, for long-term investors, what you want to do is you want to make sure you capture the market move. And so as a core part of the portfolio, not your whole portfolio, but certainly as a core, it makes all the sense in the world.
Jason, do you agree with John that there's better opportunities in the market now, if you have a kind of that medium-term horizon, than you've seen recently because of the sell-off?
Yeah, like John, we're long-term investors here at Albion, and we think that there's been 2 great opportunities to buy good stocks and diversified investment tools at a discount to their intrinsic value. So, looking at what the market has given us, volatility is uncomfortable when it happens, and certainly, if you look at the chart, every past drop, every past correction, it looks like an opportunity, and every current correction feels like risk. But the reality is there's a lot of opportunity for those that have a long-term view, and we've been taking advantage of that as well.
Talk to me, Jason, about technology shares, which have been so bruised in this fourth quarter of 2018.
Yeah. So obviously momentum works both ways, right? Those stocks have been doing very well in this bull market. They've been outperforming just about every year of the past 9 years. And eventually there's going to be some money flow that's going to trip up those kind of high-flying stocks. But, when we look at the underlying businesses, forget the price of the stock over the short run, but the underlying businesses of the FANG stocks and a lot of other stocks in technology like Visa that we consider a technology stock, Fiserv, these are great businesses that are now trading at pretty solid discounts to their, talking 30%, 35% in some cases. And again, if you have a longer term view and you want to own the best technology businesses that really this country has to offer, you have a great shot right here. So we continue to like them.
Yeah, look at Visa, up 16% year to date. Anybody would be happy with that kind of return.